Well, welcome everyone. It's delightful to see you. My name is Susan Hoffman, and I am the director of the Osher Lifelong Learning Institute at Berkeley, which is called OLLI at Berkeley. Today is the third of the fourth lecture in our series that we're calling From Boom to Bust, Insights into the Economic Downturn. The series sponsors have been the Vice Provost of Teaching and Learning, Christina Maslach, who is here today with us, and Rich Lyons, the Dean of the Haas School of Business. The spring term for the OLLI at Berkeley will begin on March 30th, and for those of you who are not currently OLLI at Berkeley members, I hope you will either check the website where the new courses for the spring will be up on Thursday, as well as online registration. There is also a color brochure, much like the one you've seen out there for the spring, so you can see what courses we'll be offering. And it's a fairly fantastic spring term, I have to say. Lots of art, science, and politics. I think you'll find it, the normal eclectic range of OLLI courses. Today we have the Educational Technology Services, which is recording today's lecture with Professor Reich, and our intention is to webcast the series. As we go into post-production, we will be letting people know through the website when to expect, so you might tell your friends when they might see today's lecture as well as the others. And now it's my pleasure to introduce Professor Robert Reich. He is a professor of public policy at the Goldman School of Policy here at the University of California at Berkeley. He has served in no less than 3 national administrations. He was regarded as the most effective cabinet secretary during the Clinton administration. He has written 11 books, including the book currently called Supercapitalism, which is available now in paperback. He's won awards. He has written in all of the prestigious newspapers and magazines, The New Yorker, The Atlantic Monthly, The New York Times, The Washington Post, Wall Street Journal, co-founding editor of the American Prospect magazine. You might also have heard him on NPR, where he's on Marketplace, on public radio, Marketplace, where 5 other million people will listen to him. And so I also understand from having worked on this series how highly regarded he is as a colleague. And so I'm delighted that he's here with us to talk about the various policy implications of what's planned for the private sector and the national stimulus package. Robert Reich.
Well, thank you very much, Susie and Christine, and all of you for coming today, and those of you who are still outside in the lobby. Is there anybody still out there? I feel badly that... Well, you out there don't feel like outsiders. You are insiders. As you can see, the current economic crisis has worn me down. It's true. It's true. I was 40% taller a year and a half ago. It's actually no laughing matter because, as we know, as you know very painfully, about 40 to 50% of our savings has disappeared. And for people who are in their 20s or 30s or 40s or even early 50s, this is not a great tragedy. But for people who are approaching their 60s or in retirement or approaching retirement, this is a problem. Now, the good news with regard to economic downturns, to the extent that there is any good news at all, is the reverse of Isaac Newton's law. That is, what goes down eventually comes up. And the question we're going to try to get to today, after I go through some preliminaries, is how long will it be until things go up again? Because again, if you are within a few years of retirement or in retirement, that's the question you really are focusing on. I want to, many of you, in fact, most of you heard Martha Olney and also Brad DeLong talk about the history of all of this. I won't repeat any of that. But what I would like to talk about are, number one, the consumer side, aggregate demand. How did we get into this specific, a deep hole as we are in, not only the credit crisis, but also the crisis of what I'll call aggregate demand. Secondly, I want to talk about the stimulus package and also the bank and auto bailouts, and maybe, if we have time, some of the consequences for the national debt. Aren't these wonderful topics? I can say I've already, your faces reveal that I've already charged you up. It's going to be very exciting. And then I will put my thinking cap on and my kind of Carmack the Magnificent futurology hat, and I will try to make some predictions. And we'll do all of that, hopefully before 1 o'clock, and leave, well, no, I was going to leave time for your questions. That is, we'll do that before 1 o'clock and then have a half hour for your questions. And hopefully anybody who is outside, you can also ask questions, and maybe you can either run in and ask a question, or maybe somebody out there will take your questions, and so you won't be a second-class citizen. All right. Now, there are two sides to this equation. One is the credit side, and the other is mostly consumer, but also business demand for goods and services. And I need to talk about both of them because the government's response really is a response to both problems. They are interrelated, but they are slightly different. Most people look at this crisis, and by the way, it's hard to know exactly what word to use because recession doesn't quite do the trick. It is not just a recession. Most recessions are milder than this, obviously, and most recessions in recent years have been brought on by the Federal Reserve Board raising interest rates a little bit too high to ward off inflation, and as a result, pushing the economy into reverse. But this is different. It's much bigger. I call it sometimes a great or the Great Recession or the Great Repression. I recently started using the word depression, and people would call me and they said, don't use that word. You are making me feel awful. You are discouraging me, and if people use that word, it's going to make things even worse. So I've started, just in the last couple of days, calling it liverwurst. Because I think that, I don't know how you feel about liverwurst, but I think that sort of tells the story. This is much worse than a recession. It is not the Great Depression. I mean, in Great Depression in 1933, 1 out of 4 people was out of work. There were breadlines. The economy came to an almost complete standstill. But we're not that far away, unfortunately, in terms of the direction we're going in. If you look at underemployment today, that is the number of people who are not only unemployed, but who are too discouraged to look for work, or who are working part-time, who'd rather be working full-time. Well, we're getting close to 14%, maybe up to 15%. Hard to measure all of these things. I doubt that we're going to get underemployment much, much higher than that. I hope not, but we don't know. We don't know. So 2 common ways of viewing what has happened. One, on the credit side, there was this gigantic credit bubble, starting with the housing bubble. If there is a single actor in all of this that we would like to blame. Do you like culprits? Do you like to think about, do you like to blame somebody? So I find that blaming, it's interesting. When I talk to some of my friends on Wall Street, and I still have a few left, they say to me, and I say, well, what happened? And they always say to me, oh, death by 1,000 cuts, or the perfect storm. Or they come up with some analogy that makes it sound like it just happened. There's nobody to blame, it just happened. But there are some culprits here, and with regard to the credit side of the equation, one of the biggest culprits, and I don't want, obviously it's very complicated, it's very interactive, but it's important to understand that Alan Greenspan did blow it in a very, very big way. And he blew it by having the Fed, and he, as chairman of the Fed, really had all the information. He had the Fed reduce interest rates down to 1% in 2003. Understandable, this is right after Enron. This is still in the wake of 9/11. There was a lot of economic, we were in danger of going into recession. Reduced interest rates, but in inflation-adjusted terms, those interest rates were actually negative. So if you are a lending institution, a bank, mortgage lender, whatever, well, how wonderful for you. You can get money essentially free. And then what do you do with it? Well, you have every incentive to do what anybody would do with all that money, that lend it out as fast as you can. And particularly lend it out to anybody, well, anybody who can stand up straight. In fact, many people can't stand up straight. I mean, anybody you can find to basically borrow the money, and particularly if you can then wrap up those borrowings like sausage into securities with a lot of other things that you can then sell off around the world. I mean, what a wonderful way of making a lot of money. Alan Greenspan not only reduced interest rates so low, but the critical problem was that he was not terribly enthusiastic about stepping up the oversight of all of these lending institutions. And that, along with a failure on his part and a failure on a lot of other people in government, starting in the late 1990s especially, to understand the importance of having a firm, clear, transparent regulatory structure based on firm, clear, transparent balance sheets in the financial sector. All of that came to haunt us because those loans, not just housing loans, I mean, there were subprime housing loans, but there were also the creation of derivatives, all sorts of fancy bets, bets on bets, bets on bets on bets in terms of where the stock market would go and how many of these loans would be repaid. Bets on insurance products, insurance bets on insurance products. And you get this world of derivatives. And this world generates huge amounts of money for Wall Street and everybody involved in finance, because every deal that they can make, every time money moves, the larger the amount of money that it moves, the larger the deals, the more they can rake in as a percentage of the deal. So everybody has an incentive to place big bets and make it larger and larger and larger. It's not just in the United States, it's in the city, in London, it's in every financial capital. They're all carrying more and more and more loans. Meanwhile, housing prices are going up. Meanwhile, consumers, and I'll get to consumers in a moment, are believing that housing prices will continue to rise. The mathematical models that Wall Street is using all are premised on the notion that housing will continue to rise. And then the burst. And most of us who study economic history know that bubbles burst. The problem is you can know bubbles burst, and that doesn't really help you understand the critical question as an investor, which is when? My own personal investment strategy is to buy high and sell low. I've perfected, that's right. You too? You too? It's a guarantee. It's a surefire. I bought a house in Berkeley. I waited until the housing market in Berkeley reached its absolute zenith. They could not conceivably be higher. And I thought, now's the time. So if you want good economic advice, watch what I do and do the opposite. So you do have a credit bubble, and that is, according to most people's story, as they explain all of this, the bursting of the credit bubble made all sorts of people feel much poorer, and that kind of negative wealth effect translated into literally everybody pulling in their belts and nobody wants to buy, nobody feels nearly as rich as they were, everybody's worried about the future, and we have a recession. I think something else was going on as well, and this is why I want to now shift to the demand side of the equation, aggregate demand. For a very long time now, median wages in the United States have not risen very much. In fact, starting in the late 1970s, adjusted for inflation, the median wage, now I'm not talking about the average. There's a difference between the average and the median. You know, average wages are going up and have been going up fine because the people at the top have been doing so well. You know, Shaquille O'Neal, the basketball player, and I have an average height of 6'1". So, you know, averages don't tell you the whole story. They don't tell you about what's happening to the little guy, and that's why we use median. Median wages, starting in the late 1970s, really did slack off. And if you look at 80% of the American workforce paid on an hourly basis, you see that median wages actually started to drop. Now, what did the typical American family do beginning in the late 70s, 80s? The typical American family didn't want to cut spending, in fact, had very high aspirations, and so the typical American family did what you would expect. They sent another person in the family, usually the woman who is working in the house, into the workforce. Now, I wish I could tell you that that great migration of women into paid work beginning in the 70s, increasing in the 80s, increasing again in the 1990s, was all because of the great professional opportunities open to women in American societies. It wasn't. Most of that movement of women from unpaid work in the house to paid work outside, put to one side the question of who's going to do the unpaid work in the house. Most of that migration happened because women had to do that in order to prop up family incomes that were dropping because male wages couldn't keep up. Male wages, by the way, why did they start declining in the 70s and 80s? They started to decline in the 70s and 80s, in real terms, hourly wages I'm talking about, primarily because of two great trends. One is globalization, and the other is technological change, culminating in software. Both globalization and software, or in other words, over there or software, allowed more and more things that blue-collar workers in America used to do here to be done more cheaply, either there or through software. That coping mechanism, sending women into work, paid work, lasted for a while, but didn't last all that long. The typical American family still couldn't quite keep up with their aspirations, and their aspirations, by the way, were not hugely greater than they were before. This is just a matter of basically keeping up. They worked longer hours. So we found by the year 2000, the typical American was working 350 hours longer per year than the typical European. Longer even than the very industrial Japanese. But that also has to come to an end. I mean, when you have usually two parents, and they're both working that long, well, there's a limit. Particularly if they have kids at home. I used to call them demographic, this demographic group, I used to call them DINS, D-I-N-S, double income, no sex. I don't know how the Americans procreated all of this time, because if you have two people who are working that long. But then we come to this decade. Now, how does the typical household continue to buy? This decade, by the way, between 2001 and 2007, a so-called recovery. This is the first recovery in history, at least, that we've been measuring these things, in which median wages actually, adjusted for inflation, dropped during the recovery. It's not a matter of them lagging, but they actually dropped. It's not just the bottom 80% dropped. It's median wages all looking at the entire wage scale. Median worker wages actually dropped. Well, how do you keep your spending going? You start borrowing. And that was coping mechanism number 3, more and more and more borrowing. As long as your house price is going up, you can use it as a piggy bank. You can borrow against, you can refinance, you can get home equity loans, and that's basically what people did. Now, fast forward to 2007, 2008, the burst. Not only do you see your piggy bank in shatters, you can no longer get home equity loans or refinance, but also you're worried about your job. and you realize you are deeply in debt, and how do you manage your debt? You can't go in any more debt. Even if the financial system were working beautifully, even if we didn't have a credit crisis on Wall Street, even if the banks were lending, you would still be having a harder and harder time getting money because you just simply can't repay. And so much of the crisis on the demand side is the culmination of a gradually unrolling, evolving crisis of median wages that began many, many years ago. It's important to keep that in mind when we talk about government's responses to both the credit crisis on the supply side in terms of supply of credit and also the demand side with regard to consumers. Consumers are about 70% of aggregate demand in our economy. If consumers stop buying, there's just not enough out there of purchasing power to keep all the goods and services being produced. And a lot of business buying, business investment, is predicated on consumers. I mean, why should a business invest in new equipment or buy a larger plant or buy anything if there are no consumers out there to buy what the business produces? So you can see that as consumers pull back, we get ourselves into a vicious cycle in which consumers' fears, rational, and inabilities to borrow more, inabilities to simply pay as much as they were paying for all the goods and services before, have a ricochet effect on businesses who then cut back, lay off more workers. Those layoffs, and right now the unemployment rate officially is 7.6%. We're losing about 500,000, 600,000 jobs a month. Parenthetical, we need 125,000 new jobs to keep up with population growth. So a loss of 500 to 600,000 jobs a month doesn't even include all of the 125,000 that we need on top of what we normally get just to keep up with population growth. We are way, way behind. So add that in and you get the vicious cycle in which consumers don't buy, they lose their jobs, they buy even less, they lose more jobs, and it is liverwurst. Therein lies the story of the stimulus. Because there has to be some way to overcome this gap between what the economy could produce at full capacity and what is now being demanded of the economy by consumers and businesses. And let's add in exports, because exports also demand things of the economy, although the world market is now not, worldwide consumers are not buying. I mean, the whole world is in a liverwurst. And so you have a huge gap between what's being bought and what the economy could do at near full capacity. That full capacity economy, something close to 14.5, maybe $15 trillion a year. And what are consumers actually, and businesses, what's the demand, what's aggregate demand this year, 2009? Well, probably somewhere in the neighborhood of maybe $13.8 trillion. So there's a shortfall of maybe $1 trillion to $1.5 trillion this year between what could be produced and what is actually being demanded. Now that shortfall is exactly the reverse of what this economy has struggled with since the 70s, which was inflation. Inflation is when you have greater demand than your productive capacity. That pushes up, that drives inflation, that makes money worth less and less. But right now we have less demand than our capacity. And what do? Well, the Fed has already reduced interest rates as low as it can to stimulate buying and lending. But now we've got to revert to the buyer of last resort. and that is government. John Maynard Keynes, the great British economist, understood something in the 1930s that very few people understood, and that was that economies are very often prone to simply underconsume relative to their productive capacities. There was I don't know if Brad got into this, but there was a famous meeting between John Maynard Keynes and Franklin D. Roosevelt, and neither of them understood the other at all. It was a complete failure. Roosevelt thought that Keynes was sort of a mathematician who was all lost in the clouds, and Keynes thought Roosevelt didn't understand a word he said, which was right. And it wasn't really until the Second World War that the United States spent enough to match or get us close to capacity, which explains why by the end of the war, most Americans were better off than they were before the war. Sort of a mystery. How could most Americans be better off after the war, given that huge mobilization that it entailed, than they were before the war? Well, basically because the mobilization caused most people to have jobs or go into the military. That gap was overcome. I'm not suggesting we need a war now, but we have a stimulus package that is $787 billion for 2 years. Now, you can see if the gap is maybe $1.3, $1.4 trillion per year, which roughly added up is $2.6 to $2.8 trillion in 2009 and 2010, you can see that $787 billion is not going to go very far. Sounds like a big term. I mean, a big amount of money. We're not used to, Everett Dirksen once said, I'll modify it for the current times. $1 trillion here, $1 trillion there. Suddenly you're talking about big money. But we're not even talking about $1 trillion. It makes people very, very nervous. The reason I believe that Barack Obama yesterday talked in the White House with many blue dog Democrats, many Republicans, about the importance of fiscal responsibility, fiscal rectitude, getting the budget under control, is because that much money, $787 billion, combined with, we haven't even got to yet, the bailouts of Wall Street and also autos, we're up into so much money, people naturally start worrying about who's going to pay for all of this, how are we ever going to pay for it? But for now, at least at this point in my discussion, let me just say to you, unless we do get up to productive capacity, the economy, by definition, is not going to be back on track. We're not going to grow again. We're going to continue to be in a liverwurst. My concern about the stimulus package is not only that $787 billion is not enough to fill the gap, but a lot of that stimulus is tax cuts. Some business tax cuts. Now, business tax cuts might be good over the long term. I don't know. There are different views on how important business tax cuts are. But in the short term, they're not going to be terribly useful because businesses are not going to invest unless they're consumers and customers to buy what businesses are investing in. Similarly, with regard to tax cuts for the wealthy or people who are upper middle class, we can have a jolly old debate about whether they are good economically, whether they are fair or not fair, but they don't make much sense if what you're trying to do is get a lot of spending going. Because one thing we know about people who are fairly wealthy or very wealthy is that when they have extra money, they don't necessarily spend it. Being wealthy means you have pretty much everything you want. That's the definition of being wealthy. And so the additional spending that a tax cut is going to create if you're upper middle class or rich is really far less than the additional spending you're going to get if you have a tax cut for the poor or moderate income people. They're likely to spend much more of what they get. But even moderate income people, we know from that tax rebate last spring, even moderate income people, what they're likely to do, first of all, when they get some tax rebate or extra money, they're going to pay down their debts. Now, this is smart. From the standpoint of the individual, this is smart. This is responsible. But from the standpoint of getting the most spending bang out of each tax cut dollar, it's not very smart for the nation as a whole. If you give a tax cut and people just put the money in a bank or pay down their debts, you're not going to stimulate spending by definition. The other problem with tax cuts is that even if you spend it, even if consumers go out and spend it, there's no guarantee that the spending is going to make or create or induce jobs here in the United States. In fact, go down to the mall and spend it at the mall on T-shirts and televisions and anything else. Chances are you're going to stimulate jobs outside the United States. Now, that's not bad. We're all in one big global recession, depression, liverwurst together. But what you want to do, presumably, the reason you're doing this in terms of a stimulus is to create jobs here in the United States. So all other things being equal, and there's a lot of debate about this, all other things being equal, we tend to get more spending bang from a buck of government spending directed at things like infrastructure or healthcare or maybe providing aid to the states who are pulling in right now and cutting back on services, because those are all here. Those are all jobs created here in the United States. Then we do providing tax cuts. But nevertheless, about a third of the stimulus package, $787 billion stimulus package, about a third of that is tax cuts. A lot of those tax cuts were put in because there was a thought that the Republican Party liked and preferred tax cuts, and President Obama wanted to reach out to them. And here we run the risk of getting into partisan politics, which I do not want to get into. Some of you may be Republicans. And I want, here in the university, and this is actually quite serious, in my classes and in seminars and so forth, I love to have conservatives and conservative Republicans, because that's the only way you learn, is if people debate. If everybody's sitting around and they are either all conservatives or all liberals, and the tendency here at Berkeley is more liberals than conservatives, then they don't learn from each other. But those of you who are Republican here in the audience, I want you to know that I respect you. I don't like you. That's not true. I like you and I respect you, and I can tell you one of the big problems we have had in government, and I can tell you exactly when it happened for me. I was there in the Clinton administration, and then in January of 1995, something happened. It was like, switching temperature zones. It was like moving from day to night. It was like, going from paradise into the corridors of doom, because the atmosphere changed. It became much more contentious, much angrier, much more partisan, and very unpleasant. Partisan politics is getting in the way of us getting a lot of things done that we need to get done. And so I salute President Obama's intention in terms of reaching out to Republicans and trying to get them to join him on the stimulus package, although I have to say that I and many others were skeptical that he could get many Republicans on board. Because I think that what the Republican Party, to the extent that there is, these parties are amorphous, and it's not as if everybody in a party marches lockstep in Washington, but I think generally it's fair to say that many Republicans are making a bet right now, and they're betting that by November of 2010, the economy will not be much better than it is today. In fact, might be even worse. And in those midterm elections, they, or at least some of them, are going to go to the public and say, you should have followed us. We should have had tax cuts. We should never have borrowed this much. And this is not working. And so we need to change horses. And their goal is to take back some seats and perhaps make it more difficult for the president to get what he wants done. And I understand that strategy because it was very similar to what happened in 1994 and the start of 1995. But it's unfortunate. What else about the stimulus? I think that there will probably have to be another stimulus package. Now, that's just me speaking. But in order to bridge the gap that I'm talking about, I would not be surprised if there was stimulus 2. And if that didn't do the trick, maybe stimulus 3. We've got to get the economy back so that it can start to grow again. Now, let me just say something about the debt, because I can read some of your faces, even before you ask questions, and you're thinking to yourself, where is all this money going to come from? How can we possibly afford this? You know, as a boy, I grew up in a rural area of New York State. My father, the first economic lesson I remember, I couldn't have been older than 4 or 5 years old. My father decided to talk about Franklin D. Roosevelt. I don't know why. I didn't know who Franklin D. Roosevelt was. Maybe he had been talking about FDR since I was born, but I just don't remember it until I was 4 years old. But he talked about Franklin D. Roosevelt, and he said, Bobby, he called me Bobby in those days. He said, Bobby, I want you to know something. Franklin D. Roosevelt was our president, no longer. Harry Truman is our president now. But Franklin D. Roosevelt was our president, and you and your children and your grandchildren and your great-grandchildren and possibly your great-great-grandchildren will be paying the debts created by Franklin D. Roosevelt. I didn't know what he meant, but it scared the hell out of me. Well, it turned out that that was not quite the case. At the end of the Second World War, we owed the equivalent of about 120, actually up to 140% of the whole national economy per year. I mean, we actually owed more than the entire national economy could produce in a given year. The debt to GDP ratio was extraordinarily high. But then what happened? The ratio came way down. It came down not only because we didn't borrow as much, we were not fighting a war, but we did have a Cold War. We continued to borrow quite a lot for not only the Cold War, but for civilian needs, interstate highway systems, National Defense Education Act. We did a lot. We expanded education dramatically in the 50s, 1960s. It wasn't so much that we borrowed so much less, it was that the denominator of the equation grew so fast. Debt to GDP, ratio of debt to national product. The national product kept growing very fast, not only because there was a great deal of pent-up consumer demand, but also because we had prosperity, and broadly and widely shared prosperity. Mass production, mass consumption. The economy grew. So fast forward to 2009, 2010, 2011, 2012, it is important when we can to reduce our indebtedness, but the most important thing is to get the economy back on a growth path. The denominator needs to grow and grow again quickly. Now, for those of you who might be saying, well, wait a minute, haven't we been growing too fast? All these environmental problems, don't we buy too much stuff? No, growth includes the capacity of a country to get on with whatever it needs to do. Environmental pollution controls, providing health care to people who can't afford it. We're not talking about how the growth is divided up. We're just talking about growing the pie. Were we to make the terrible mistake that Franklin D. Roosevelt made in 1936 of reducing government spending before we actually got back to near full employment, we would experience probably the same thing that Roosevelt experienced in 37 and the country experienced in 37, and that was a fall back into recession, or worse, depression. So the way I view it, the problem is not likely to be too much stimulus. The problem is likely to be too little stimulus. Where do we get the money from? It's mostly China and Japan. They are our biggest lenders. Are they going to continue to lend us all of this money? Well, the answer is probably yes, for a couple of reasons. Number one, because the dollar is a safe haven right now. This is a world, remember, where there aren't too many great investment opportunities, and there is a lot of fear. And Treasury bills are the place where a lot of people around the world and a lot of governments want to park their money. This is not a problem. In fact, this is a good thing for us because it means we don't have to pay much interest on everything we're borrowing from the rest of the world. And chances are the worldwide recession will last even longer than the US recession, or the worldwide liverwurst, longer than the US liverwurst. Why is that? Because we are the first one going down and we're the first one usually coming up, because we are the consumers of the world. Therefore, the dollar is likely to continue to be a pretty safe, good bet for the rest of the world. And besides, China doesn't want a run on the dollar. China doesn't want the dollar to drop. I mean, that would leave China holding a lot of securities and a lot of currencies that don't really don't have that much worth attached to them. And also, it would mean that China would have an even worse time selling its goods. So I don't think, at least for the time being, we need to worry about China and Japan. Their economies are in trouble, by the way, but it's all relative. China was growing at 11% a year a couple of years ago, about 9% a year last year. It's now growing, maybe, we don't know, but maybe 6%, 4%, 5%. That's not good for China in terms of dealing with a lot of social unrest. You've got millions of people coming in, hundreds of millions of people coming in from the countryside. But from the standpoint of generating the kind of money and savings that can help us, that's fine. Doesn't mean there's no limit to how much we can borrow. Doesn't mean that borrowing is necessarily always good. But when we're in the deep hole we're in, we have to. Now, what about Wall Street? And what about the auto industry? And what about all these bailouts? Tim Geithner did not exactly inspire Wall Street with his announcement of Tarp 2. I am a student of language. I love the way language is used and how we use language to signify and symbolize various things and euphemisms we use. Tarp. I always thought a tarp was something that was used to cover things up. And that's how Tarp 1, that is under Hank Paulson, that's how Tarp 1 was utilized. It's sort of, still to this day, not many people know exactly what happened to the first $350 billion. I mean, we know that big chunks of it went to Citigroup and to AIG, and it went here and there, and we know approximately how much has gone, we know almost exactly how much has gone so far to the big three, but exactly how it was used and has been used, still a lot of uncertainty about that, which led President Obama and Tim Geithner to say, essentially, to the public and to Wall Street, look, if you want more of this money, Tarp 2, then you are going to have to mend your ways. You can't use it to provide dividends to your shareholders. You can't use it for big bonuses. You can't use it to buy up other companies. You can't use it to buy up your own shares of stock. The purpose here is to recapitalize you and also to do it in such a way that you will feel free to lend again. Now, the most important aspects of what Tarp 2 holds were not actually revealed at the news conference, which I think why, to some extent, Wall Street got a little bit unsettled. Uncertainty is always bad for markets. What's really at the core of Tarp 2? It's something called a stress test. Now, I would like to have a stress test. Some of you would like to have a stress test. When I was Secretary of Labor, there was a nurse who came around. I remember I was there, the first week I was there, she just appeared. And without saying a word, she put a cuff around my arm. And she proceeded to, and she was completely silent. I was going over some work. I had to have some meetings, and I said, as she was pulling, I said, I'm sorry, who are you? And she said, oh, I'm the department nurse. And I said, oh, well, what are you doing? She said, I'm taking your blood pressure. I said, well, I know that, but why are you taking my blood pressure? She said, well, I'm giving you a stress test. I said, well, why are you doing that? She said, I do this for all the secretaries. I said, well, that's very, very interesting. She said, it's amazing. When you come into this job, your blood pressure is at one level, and then after a year or two, it's much higher. And I want to keep track of all of this. I said, thank you for keeping track. But the stress test that Geithner has in mind is sort of a, yes, it's sort of a blood pressure test, but what he's really going to do, and what Treasury is going to do, at least theoretically, and I think they're probably doing it right now, is going over the balance sheets of these banks, particularly the big banks, to see if they can kind of make a judgment about how much the assets of these banks are actually worth, regardless of what the banks say they're worth. Because remember, a lot of these assets are going to be worth far less because they're non-performing loans. It's not just the subprime housing loans. It's not just people who can't pay their mortgages. It's also, as the recession, depression, liverwurst deepens, it's a lot of things that looked like good loans a year or two ago, but now have become bad loans because people can't pay their credit card bills, or they can't pay their car loans, or they can't pay a lot of other things. Or even housing, mortgage loans that were good bets a year ago may be worse bets. So what do these balance sheets, what are these assets really worth? 20 cents on the dollar, 30 cents on the dollar, 15 cents on the dollar, and Geithner and company are going to make a second determination, which is if this liverwurst lasts more than a year, or a year and a half, or 2 years, if it gets really bad, what's the likely result for these balance sheets? How many banks are technically insolvent right now, and how many are likely to be, even if they're not insolvent now, likely to be insolvent if it gets much worse and if it stays bad for a long time in terms of people not being able to pay back their loans? Now, on the basis of that stress test, I expect there will be a kind of triage. That is, Geithner and company will say, well, these banks are perfectly fine. They're pretty healthy. They don't need a bailout. Let's just leave them alone. These banks over here are basket cases. I mean, they are insolvent now, and they're not going to become solvent, and what we ought to do is just put them in receivership. The Federal Deposit Insurance Corporation ought to guarantee the deposits, and we ought to essentially just close them down. And then we have these in the middle, and it may be a fairly large number. And these banks in the middle are salvageable, but they're going to need some help. We've got to get these toxic, bad debts off the balance sheets if the banks are going to have half a prayer of being solvent and also making new loans. How do we do that? Well, we're going to coax and also bribe investors with loan guarantees from the Federal Reserve Board and Treasury to buy up a lot of these toxic securities. And we're going to have them compete against each other in buying up these securities, and that competition may yield an approximate value that is real. Because if you've got individual investors who are competing to get these securities with some guarantees attached so they won't lose their shirts, you create a little competition that may reveal what the underlying values are considered to be. Do you follow me? And the big debate that is emerging over this group of banks and what Geithner plans to do is whether the public should have some control. If the public is risking a lot of money, if the public is putting a lot of capital infusion into these banks, to what extent should the public be able to say, look, we are in control of the banks. That's the only way we're going to know exactly what these balance sheets are worth. That's the only way we're going to be able to really understand what's off the balance sheets in terms of derivatives and others. And by the way, it's the only way we're going to be able to get rid of lousy management. Now, other people say, no, that we shouldn't even fiddle with the public getting involved or the Treasury Department actually getting involved. The Treasury Department and other public managers don't know the slightest thing about banking. It'll just make the situation worse, the argument goes. And it also sounds like nationalization. socialism. So there's a little bit of that debate going on. I think it's somewhat of an academic debate. I think what's actually going to happen is that with this regard to this middle group, there will be much more government oversight. The banks are going to depend on government a great deal. The government and the Treasury Department are going to have a lot of leverage in terms of possibly even going so far as to getting rid of some managers. It's going to look and smell and feel an awful lot like government ownership, but it's never going to be called government ownership. Now, should Washington be doing all of this? Citigroup has just said it needs even more money. In fact, if you look at these balance sheets, it looks like they're getting worse and worse and worse and worse for Citigroup and Bank of America and a lot of them. Should government be bailing them out, or should we just have a kind of massive reorganization under bankruptcy and have shareholders take a complete haircut? I mean, the share prices of many of these banks have already gone down to almost nothing, and have creditors of the banks get back 20 cents on the dollar, and have depositors protected up to $250,000, obviously, and just reorganize the banks and write everything off. Well, maybe that's a good idea. The trouble is, if you start talking like that, immediately people start saying, well, Lehman Brothers, look what happened with Lehman. You're going to start a run on the banks. You're going to, basically, the whole system is going to start imploding. Well, if Tim Geithner is going to do what I suggested that he's probably going to do, it's going to smell and look a lot like not only public ownership, but also have some resemblance to a reorganization under bankruptcy, but probably not called that. What about the auto companies? Well, the auto companies are already in various states of what finance people call workouts. That is, they are already negotiating with their creditors and negotiating with their preferred shareholders and negotiating with their unions and negotiating with their communities and their states to get as much of a break as they possibly can so that there's as much capital as possible to actually pull off a reorganization and a restructuring. And the federal government, I expect, is going to be willing to put up some money on condition that all of these other stakeholders put up some money too. In fact, really, the bait for everybody making sacrifices is the federal government's willingness to put up some money. That's how we did the Chrysler reorganization in the beginning of the 1980s. And this is just going to be that on a much, much larger scale. Should we be doing that at all? Why not let the auto companies go into reorganization and bankruptcy formally? Not just a workout, but a formal Chapter 11. Well, many people have good arguments for that happening. I think that it might be dangerous for the auto companies because there are not many people, consumers, who want to buy cars from companies that are officially in Chapter 11 bankruptcy. People just worry about, what's going to happen to the value of this car when I want to sell it again or want to get servicing. But there will be some form of effectively Chapter 11 reorganization, even though it won't be called Chapter 11 reorganization. AIG, big insurance, also is going to come back for more money. Now, the way I view it, and this is just my personal view, all of these bailouts ought to be judged by the criterion of what is the effect on Main Street and what is the effect for working people. From my perspective, it doesn't seem to me all of that useful for General Motors, for example, to come to the government and say, well, we will want another 20 or 30 or 40 billion dollars, and by the way, we're laying off 20 or 30 or 40,000 employees. It seems to me that it ought to be just the reverse. The government ought to say, as a condition for providing all of this funding, you keep as many employees as possible, because when the economy turns up again, hopefully in not too many years, you want to have these people there. Otherwise, the unemployment insurance costs and the lost taxes are a kind of a double burden on the government and on these communities. But that's just me. Let me conclude by giving you some predictions and some reasons for hope. If not elation. First of all, as I said, what goes down comes up. The Pollyannas, and I deal with many Pollyannas, a lot of the business press and a lot of the business media on television, they are professional Pollyannas. They don't know how not to be Pollyannas. They have every reason to try to put the best face on everything that's happening. The Pollyannas think that we're going to actually reach bottom and maybe turn around by the end of this year. I hope they are right. I don't see any indications suggesting that they are. Now, business inventories will get down to the point where businesses have got to reinvest at some point. Consumers, will get to the point where they've got to buy at least a used car or a new car or more furniture or more appliances. I mean, the old ones die. I mean, there is a natural point where inventories and consumers and everybody have to turn around. But remember, we're still in the vicious cycle part of this cycle in terms of job losses. We'll know a lot more January when the February figures come out. We'll know a lot more when the March job figures come out. But I would not expect a turnaround, or at least hitting bottom this year. Now, the Chicken Littles of the world, and those are the people who really think there is a very substantial danger of a Japan-like lost decade featuring deflation. That's the worst thing that can happen because once you get into a deflationary cycle, prices start dropping and everybody waits. Because why buy a new house? Why buy securities? Why buy anything when you expect prices to keep on dropping? And that is almost impossible to counteract. I mean, government would have to spend far, far, far more than even a major stimulus package. The Japanese did suffer deflation. Everybody hopes that won't happen, but the worst case scenario is a kind of a 1930s or Japan lost decade type situation. I think the chances are not likely because I do think the stimulus package, or at least stimulus number 2 and 3, will be big enough. So I think we're going to hit bottom and begin turning around in 2010. And I think that once we turn around, it's going to be a pretty healthy turnaround. Now, I hope I'm right. I have a reputation for being a little bit of a soothsayer economically, because in the first week of October of 1987, I was on a nationally televised television business show in which I was pitted against another economist, and the question was, what's going to happen to the economy? And this fellow said, over the next months, it's going to be I would be very bullish. Get in the market, get in as fast as you can. Don't even wait to the end of this program to find out what is going to happen. Call your broker, get in. And I said, no, in 2 weeks, the market's going to lose 20% of its value. This was the first week of October of 1987, I said this. And in 2 weeks, the market did lose 20% of its value. And I was deluged with letters and telephone calls, people wanting to sign up for my investment letter. What I did not tell them is that could you keep it in this room? And you in the corridor outside, you please as well, promise me? That prediction that in 2 weeks the market would lose 20% of its value, I'd been making exactly the same prediction for 4.5 years. Which suggests that if you stick to your guns, eventually you can have your own investment letter. No, I do think, though, that the chances are very good in 2010 for a turnaround. But the other thing I want to say about all of this is that hard economic times do have one very important silver cloud. They have a silver cloud, they have a silver lining. And that very important silver lining is that there are opportunities to innovate in organizations, in businesses, in not-for-profits, in public sector organizations. There are opportunities for innovate that you cannot actually possibly have or do when times are good. When times are good, everybody basically wants to keep going the way things are. Innovation is possible, and I do hope and I expect that the Obama administration will use this opportunity to innovate. It is already beginning to innovate in terms of public investments, which are critically important. I think other places, other organizations are already also trying things that they would not otherwise try. Not everything is going to work, but innovation and change create enormous opportunities. The other thing I want to say, and I don't mean to be too rhapsodic about this, because many people are hurting, and hurting very, very badly. But there are also many people in the middle class who, although they're hurting relative to where they were 2 years ago, but they are being forced through all this to re-examine the way they live and ask themselves some pretty fundamental questions about whether they need to live the way they did live before. And it's not completely clear to me that asking these questions is a bad thing. In fact, out of this may come some fairly profound changes in the way we think about consumption and the economy and what the meaning of a good life is. Again, I don't want to paint with a kind of a bright brush. This is not a happy time, and it's certainly a terrible time for lower income people or people who have lost their jobs or people who are poor. But again, a time to step back and reflect, a time to think about what you are doing in life, even as a retiree, is not necessarily a bad thing. And on that upbeat set of notes, I want to thank you for your attention and invite your questions. Thank you. Thank you. Okay, questions? Yes.
Two quick ones. First of all, why aren't they calling it a jobs bill instead of a stimulus bill? And secondly, how does the spending on the wars that we're in fit into this?
Two questions. One, why aren't they calling it a jobs bill instead of a stimulus bill? And secondly, how does war spending fit into this? The Obama administration and the president himself have stressed that the core of this is jobs. I think the reason that they and all of us have fallen into the vocabulary of stimulus is because in economic policy terms, I mean, I do economic policy. In economic policy terms, these kinds of programs are legitimized and understood as being designed to stimulate the economy. Now, the output and outcome of stimulating the economy is to create a lot of jobs, ideally. But they're not jobs bills per se. Your second point about where does the military spending come in all of this? Well, I don't want to be misunderstood with regard to my little historical lesson from Franklin D. Roosevelt. I don't think military Keynesianism, as it were, is the way out of this. In fact, President Obama yesterday, when he talked about future savings, talked about hopefully getting troops out of Iraq and reducing military outlays as a way to do what we need to do over the long term, health care and environmental protection and education, goals that he made a start on in the stimulus bill, but only a small start, and only a start to the extent that the spending could happen immediately. But many of these public investments are critical to the denominator of the equation I gave you before, the debt-GDP ratio. If we make the public investments we need to make in healthcare and education and infrastructure and the environment, we can have growth and more sustainable growth. If you followed the logic that I gave you before about how consumers could not spend because median incomes were actually stagnant or declining, Well, how do you reverse the decline of median incomes? One way you do it is you invest in the productivity of your people. And that means infrastructure and education and healthcare and a lot of things over the long term. In order to do that, we're going to have some revenues. And some of those revenues are going to have to come from, hopefully, reduced military expenditures. Some of them, eventually, not right now, but will have to come from higher taxes on the wealthy. Now, when I say higher taxes on the wealthy, sometimes people get a little bit nervous. I mean, here we are in Berkeley. But even here, I can feel a little, let me just, by way of context, and I won't dwell on this. When I talked about median wages stagnating or actually declining, many people hear that and they say, well, what happened? I mean, the economy has been growing for 30 years, hugely. Well, what happened if the median wages are actually stagnating or declining? What happened to all of the earnings and all the wealth? And the answer is, they went to the top. This is not in any way a criticism of people at the top. This is a matter of structural change in the economy. People who are very well educated, well connected, in the right place, at the right time, with the right skills, they have been richly rewarded in this economy. Much more richly, proportionally, than ever before. To give you an example, as recently as 1980, the top 1% by income was bringing home 8% of total national income. But then wealth and income began to concentrate more and more and more until in 2007, the top 1% was bringing home 22% of national income. Now, obviously, if you remember what I said, being very wealthy means you're not going to necessarily spend very much because you already have most of what you need. Now, so that one natural, almost inevitable corollary to that degree of concentration of income, and we haven't even talked about wealth, is that you're going to have a tendency toward inadequate aggregate demand in your economy. This is exactly what happened in the 1920s. In fact, in 1928, the last time the top 1% by income in the American population was taking home more than 20% of total income was 1928. And you know what happened in 1929. Now, I'm not suggesting direct cause and effect, but I am suggesting indirect cause and effect. So increasing taxes on people at the top may be economically wise. Questions? Yes?
We hear all the time about how the costs of health care are burdening employers. Even the large automobile companies a few years ago got together and said they want that burden lifted from them. How important do you think it would be for the government to enact more immediately, put in a higher priority on taking the health care costs off of the employers? And what would that do to restore industry in all levels?
Yeah, I'll repeat. The question is, if government took the healthcare costs off of employers, and a lot of our big employers who have legacy costs, they've promised their retirees, they've also promised their current workers, most of them unionized, they are at a competitive disadvantage. If government took those costs off, would it make those companies more profitable and more competitive? And the answer is probably yes. Now, the legacy costs are already there. I mean, even though we have Medicare, those union employees in certain big companies, particularly the big three, were promised even better than Medicare. And presumably something has got to happen with regard to those costs. There's no way that the big three can manage those legacy costs. With regard to medical costs and medical care overall, I think there will be a shift out and away from big employers. The healthcare system that the Obama administration is probably going to recommend to Congress is a pay or play system. Employers over a certain size will either provide their employees with health care, or they will pay into a common fund on a per capita basis from which people who do not have health care can draw. Maybe means tested. Yes?
What is your opinion of the potential contribution to the GDP of the green industries that are so popular right now?
What's the potential contribution to the national product, to the national economy of the green industries that are so popular? Well, it would have been helpful, ironically, perversely, if oil prices had stayed much higher. But with oil prices half what they were a year and a half ago, or a year ago, and with fuel prices at the pump a half of what they were, there is less of a natural market incentive for people to weatherize their homes, insulate their homes, to get to buy Priuses. I call them Piuses. And there's less movement to hybrids, to electric cars, to all sorts of other things. I think anybody who's looking at the tea leaves, though, knows that oil prices are not going to stay low. The reason they're low is because there's worldwide liverwurst, and so that there's not very much demand for energy. But the minute we come out of this, oil prices are going to go up. So you don't have to be a rocket scientist to say, we as industry ought to be investing in non-carbon-based fuels and also alternative technologies, both for the environment and also because oil prices are going to continue to rise. That's where two things are very important. One is the grants and subsidies in the stimulus package for alternative energy. So you can get a kind of more of a headwind going on this. The second is the cap and trade system itself, which is likely to be the system that we ultimately use and other nations use for controlling the emission of carbon dioxide. Yes?
Was yesterday the bottom of the stock market?
Very important question. No, in 2 weeks. Yes, sir.
Yeah, I heard a discussion by a man by the name of Andreessen, who started the network Netscape, presenting the position that modern banks are really going to become online entities, and basically banking is a very simple business. It's a matter of taking in money and lending it back out. And is there really a need for all of these buildings and all of these executive offices? And if that's the perception, how does bailout really bring that kind of an evolution about? Or maybe perception?
Yeah, it doesn't. I mean, there are really two, when we say banking, we're really talking about two different things. One is the old-fashioned intermediation. That is, there's savers already over here, and there are borrowers over here, and you need, how do you get the savers and borrowers together? In the world, there are a lot of savers called Chinese and Japanese, and there are a lot of borrowers called Americans and Europeans, and you could conceivably just put them together through all sorts of computers, and even nations can borrow from one another. That's not technically complicated. But there's a very different understanding of banking, and that's an investment vehicle. A lot of people want to put their money into places where they can get a high or as high a return as possible. That's where a lot of the complicated intermediary functions come in. That's where we have a casino called the stock market. That's where we have all sorts of fancy instruments. Now, we're going to have to regulate Wall Street in terms of making sure that all of that investment function on behalf of other people, using other people's money. Louis Brandeis wrote a wonderful book in 1913 called Other People's Money that really had in it almost every aspect of the current debate. But we're going to have to regulate to make sure that we don't have the conflicts of interest, such as we do now have with credit rating agencies who are being paid by the companies whose issues they are rating, and that we do something about the compensation systems in many of these places that are geared to very short-term bets and have, all of the incentives are to make big bets and then to not care at all about the consequences of these bets. Disclosure with regard to capital requirements. All of this comes on the investment side. Yes?
You mentioned you bought your house at the top of the market. Would you sort of talk about, because it seems to me that this whole downturn started with the mortgage interest and the whole housing collapse. And would you talk about that?
You mean
About what you think about
what I did, why I did it, how I feel?
and restating mortgages and the restating interest or what?
Yeah, well, when I referred before to very, very low interest rates, almost free money for the lending institutions and the mortgage lenders, that's where they threw money at the door at anybody who could stand up and created a lot of vehicles.
Yeah, but what do we do now?
Oh, what do we do now? Well, there's no, here, the housing mortgage mitigation plan that came out of the Obama administration last week, I think is a good start. But you're dealing with completely contradictory goals, and nobody's found a good way around that contradiction. The goals are, on the one hand, to make sure that people who are in their houses and are relatively good credit risks, that is, they could meet their mortgage payments if there was mortgage mitigation, can stay in their houses and continue to pay at some interest rate and pay down, hopefully, the principal over some period of time that enables them to, well, it's good, it's better for them, it's better for the banks, it's better for the communities to have somebody in and paying than a vacant house with nobody paying. But on the other hand, you don't want to risk what is called moral hazard. You don't want to reward people who should have never taken out these loans. You don't want to generate even more risky loans in the future. You don't want the public to be left holding the bag for mortgage bankers that should have never made these loans in the beginning. And how do you exactly overcome that contradiction? Well, you do it maybe by trying to come up with ways of finding out who out there could reasonably meet their mortgage payments if it were, let's say, a 30-year fixed mortgage at 5%, versus those people who really ultimately are not going to be able to stay in their houses. Sort of another version of the triage I mentioned with regard to the banks. That seems to me to be behind the mortgage mitigation efforts. Yes?
What's your advice to Obama about dealing with the Republican sort of intransigence to his programs? And the second part of that is somebody that heard you and Newt Gingrich in October. What are you hearing from Newt Gingrich in terms of Republicans and what's going on, and what's his role in that? He seemed pretty agreeable with you in October, but I'm sort of curious about now in his role with Republicans.
Newt and I talk every day. Kind of check in, how are you doing? Political, the market, everything else. No, I think that, I don't know about Newt Gingrich, but I do think that the Republicans are having second thoughts about the strategy that I mentioned a half hour ago, which was basically kind of a scorched earth strategy right to 2010, because I think they're seeing the polls. Obama's favorabilities are still way over 60%, and the Republicans are being blamed for being intransigent. It's beginning to backfire on them. They're looking at these polls very carefully, I'm absolutely sure. And many of the leaders and strategists in the Republican Party are saying, are beginning to reconsider. Still a debate. Republicans are debating. You know, for years, it was the Democrats who never agreed, and the Republicans went and walked in lockstep. And now we have fairly high degree of agreement among Democrats, and the Republicans are really starting to debate, even though they were in lockstep over the stimulus package.
And your advice to Obama about
I cannot, will not, should not tell you any communication I've given to anybody around Obama, but what I would say, generally speaking, to somebody in Obama's position right now is that there's a difference between bipartisanship stylistically and, on the other hand, giving away the store before you even negotiate. And I would say to somebody in Obama's position that it's very important to maintain an air of openness and dignity and not squabble and use a kind of a civility, raise the level of discourse, have a meeting in which you talk about economic issues, and the first person you call on is your opponent in the election. In other words, be above it, really be above it, stay above it. But when it comes to negotiating, be a tough negotiator. Don't give away anything until you have their agreement signed on the dotted line that they're going to be with you. Yes?
What, if anything, do you think this says about Reaganomics?
What does all of this say about Reaganomics?
If anything, yeah.
I don't know. I mean, I think that there is a legitimate debate, and there has been for years, about whether trickle-down economics, that is supply side, you give tax breaks to the rich, and ideally it trickles down to everybody else because they have more incentives, so the story goes, to invest and to build and to innovate. I don't think that the story of either the 80s, and certainly not the story of the last decade, substantiates that theory. The Bush tax cuts of 01 and 03, which the lion's share of which went to the very rich, did not trickle down, as I said. In fact, nothing trickled down.
So why do you think the Republicans are still on that same kind of page?
Why are the Republicans still talking about supply-side economics? You're asking me? Okay, we have time for just time for a couple more in the back.
Yes. Would you give us an idea that the cost of the stimulus is a concern to many people? How is it going to be paid for? Could you talk about the velocity of money and how that might offset or even pay the whole thing for stimulus 1, 2, 3, etc.?
No. But look, I think the bottom line here is that it's not irrelevant how we're going to pay for this. But if you followed my logic, the real issue is debt, GDP ratio, growing the denominator as fast as we possibly can get to growing the denominator. In the meantime, we're going to have to borrow a lot, hopefully with a relatively low interest rate because the world economy is still in the doldrums. And that's the story right now. The part of the story I have not yet told you, however, which we maybe have 30 seconds, but you've given me an introduction, is that the actual federal budget deficit, or what the Treasury is doing with regard to the stimulus package and the bailouts, only is only the tip of an iceberg. Look at what the Federal Reserve is doing. The Fed is essentially printing up money. $2.5 trillion so far to back up the credit markets and taking in a lot of collateral and doing, very, very little oversight of all of this. And this is all borrowing. Ultimately, this is all borrowing too. So don't get fooled thinking that the budget deficit or even the cumulative debt that is represented by the deficits is all of what we're talking about. We also have in the future, obviously, the boomers are going to be retiring. Social Security is not nearly the problem that some alarmists have made it out to be. Medicare is a much, much bigger problem. But I think that if we can get some control over medical costs, if we do have medical information technologies that are modernized, if we spend some time on prevention, if we also have the federal government given the authority to use its bargaining leverage with the pharmaceutical companies, given Medicare and Medicaid, to actually get drug prices down. Doing all of that will have a very, very powerful impact in reducing Medicare costs. I should say prevention is critically important here. My father began walking 5 miles a day when he was 81 years old. Today, he's 95, and we have no idea where he is. Thank you all.